So thank you guys for joining today's webinar, talking about Fabless semiconductor space and the Nvidia earnings we saw yesterday. My name is Nick Frassi. I'm Associate Product Manager here at VanEck. I cover a variety of our thematic ETFs, including SMH, as well as our newly launched SMHX, which went live yesterday. I'm pleased to be joined by Angus Shillington. He's the Deputy PM for our Emerging Markets Equity team. Angus also covers a handful of semiconductor names, as well as assists the product team in distilling the current semiconductor environment. So that's why I brought him on. And today we want to walk through a few things with you, right? So first, Nvidia earnings yesterday is the primary driver for why everyone's here. Their performance has been a big driver for the industry as a whole, and their earnings the topic that is most requested. So Angus is going to break down his key takeaways from the Nvidia earnings call yesterday, and then we're going to go over what the outlook is for Nvidia moving forward. Additionally, we want to put this into context of the semiconductor sector as a whole, outline Nvidia's fabless business model, and then we want to talk about the opportunity within these fabless businesses, and touch on our new ETF, SMHX, the VanEck Fabless Semiconductor ETF. And then finally, we're going to end with a Q&A session to answer everything we have missed. So as we're going through this, feel free to ask questions in the chat below, and we will try to get to those at the end once we walk through the presentation. So with that, I'm going to turn it over to you, Angus, to walk through yesterday's earnings report from Nvidia.
Great, thanks, Nick. Welcome, everyone. So I guess by now, most of you who are on this call probably have a basic understanding of the result headlines. Basically, a beat in the second quarter on revenue and margin. I think I would call these numbers solid. But I think the share price today sort of gives you a little in terms of where expectations might have been. So maybe just jump straight to the call. And certainly what I felt I learned that was new. Point one, I think it seems pretty clear that first quarter was peak gross margins for this financial year. The exit margins, meaning where margins will be as we exit this year, so the end of the year, probably be around the sort of 72, 73 range, which is a little less than we're accustomed to, still exceptionally high. And I think mostly this is product mix. And then I think on revenue guidance, which is a line that people look at pretty carefully, the guidance didn't punch the lights out as it has done in the recent past. And I think that's an important read through in terms of how you think about the name going forward. That said, management appear to have resolved this sort of quite well-known production issue in the next generation Blackwell GPU, and they're incredibly positive on demand on AI, as we are too. It's an exceptional theme and an exceptional place to invest going forward. How we would think of sort of interpreting these numbers. Again, I think 3 points here. One, we'd agree with the sort of simplistic read in the lower share price on these numbers and this morning, which most likely implies that expectations on guidance were probably higher than Nvidia provided on the call. The second point, I think we're looking for, and I don't think this is outside of expectations, a leveling out of Nvidia growth. We're going from super normal levels of the past year or so to something probably approaching more normal. Of course, part of this is as the numbers get larger, it just becomes more and more difficult to hit these beaten raises that we've gotten used to in the past. So there's partly that, but also partly supply demand sort of moving towards equilibrium, and competition beginning to emerge in certain parts of the ecosystem. And I think that sort of leads you to the big point 3, which is the focal point now must become the multiple and where positioning would stand on the name. So by way of sort of conclusion, sort of what is our kind of anchor narrative? And I think any of you who have followed, Jan VanEck on social media or his pretty extensive press appearances recently will be pretty familiar on our kind of house view. We've been careful, he's been careful to highlight these risks and the likely need to sort of consider diversifying exposure and lighten up on really large positions in Nvidia, and that there's a regime change kind of in play. I think broadly speaking, that the sort of semi space has underperformed the broader market since kind of mid-June. So I think that narrative has somewhat played out, certainly over the shorter term. And I think yesterday's numbers and guidance fall squarely into the sort of narrative that we've been talking about. Given this narrative, and I think Nick mentioned this, that he and his team have built this super interesting product. And he's going to pitch that idea to you, which sort of keys off of this narrative, but also off of this idea of Fabless as a business model. So let me clear and wrap this up. The wow factor, of the results that we've sort of gotten used to in the past is fading somewhat. And to some extent, that is to be expected. Now the debate needs to move to the sort of wow factor that is still in the stock multiple. Certainly the business model is excellent. The business itself remains exceptional. But this stock may trade to a lower multiple, and that's sort of our feeling around the sort of diversification recommendation or call. Now, what does that look like? Very easily the stock could do nothing as the time allows earnings to grow the to shrink the multiple, or there's possibly the share price comes off somewhat. Either way, this diversification idea remains probably the right place to be. And I think it's important when you make a call like this to explain what would wrong look like. If this did not turn out to be the correct view, what would trigger that? And that's probably simply that, material catalyst or a material catalyst emerges in, the next quarter or so that was not the earnings call. And that sort of feels sort of on the less likely side to us. So again, I think just looping back and sort of as we sort of take the rest of the call, that this Fabless business model, this idea of design and outsourcing manufacture is the future. I mean, Nvidia has shown us this model working to perfection, but it is also prevalent and investable around many other companies in this space. So Nick, let me pass it back to you.
Yeah, for sure. And we appreciate that, Angus. I think we're all in the same camp as like Nvidia. Unbelievable company. The Fabless, business model we think is very opportunistic, and normalization of Nvidia's business doesn't mean that it's a bad business, right? So much so that we really took a deeper dive at the Fabless space and saying, there's a lot of opportunity out there for other companies to come in and compete for Nvidia market share. So I think that's a good segue here. So I thought what we would do is kind of define Fabless. I think maybe that's not something that's in the lexicon for everyone yet. So to really understand what Fabless means, what Fabless is, and then how did we get there, and what it, over time, what does that look like, I think is important. So to take a step back, right, from a 10,000-foot view, what is a fab, right? So a fab is a wafer manufacturing plant, right? This would be like the TSMCs of the world. They're also referred to as foundries, some people call them. So fabless would mean and be defined as operating without manufacturing, without one of these fabs, without a foundry, right? So you're outsourcing the manufacturing of these chips that you have designed. So a fabless semiconductor company designs, develops, and sells the chips, but outsources the actual manufacturing of it to specialized foundries or fabs, right? So I think that's just setting the stage and defining exactly the different business models that are within the semiconductor industry, because I think a lot of times people don't understand that there are layers to this, right? And they all operate individually. So, what is the next logical question? I think, what are the advantages of this fabless business model, and is that what's made Nvidia so successful? And I think it is, right? A fabless semiconductor company focuses on the designing and developing of the chips while outsourcing that manufacturing to specialized foundries like TSMC. And these companies avoid the high costs. the complexities associated with running their own production facilities. And we've seen some other players in the space, run into issues with that, where they're vertically integrated, these integrated device manufacturers, and it makes it much more difficult, in this type of architecture to be successful. So operating without their own fabless businesses can concentrate more on the innovation. They can allocate greater resources to R&D. This is going to lead to the potential for faster product cycles, which we've seen from Nvidia, right, on their different GPUs that they've been able to release, increased profit margins, and stronger competitive edge in the market. So unlike those integrated device manufacturers, when we think integrated, right, we're thinking vertically integrated. They design, they manufacture, they do everything in-house. Fabless companies can really bring advanced technologies to the market more quickly and efficiently, and can pivot, right? And we saw that with Nvidia being primarily a GPU producer for gaming, et cetera. And now they're the world's largest server or data server manufacturer for AI, right? So the ability to be able to pivot like that is really what makes these companies interesting, and not having the the capex spend on the manufacturing itself. So, Angus, maybe you can talk a little bit about the key business dynamics that go on within Fabless, these Fabless semiconductor companies that are distinct from the more traditional semiconductor firms that we think of, maybe, when you're thinking about the space.
Sure, Nick. Yeah, I mean, I think it's the sort of what is the optimization proposition, or what is the product market fit, and the way to sort of, if you could sort of contrast the IDM model, which is really sort of more where Intel is right now, and that they're certainly struggling to get their arms around growth going forward. If you are tasked with building, investing, managing a manufacturing process, you will have more of a tendency to integrate your design with that manufacturing, meaning that you're trying to optimize manufacturing at the same time as you're building chips for customer benefits. So you are much less flexible in your design approach, because you are somewhat hamstrung. Now, there are some good reasons, or there have been some good reasons in the past, which have been more and more invalidated as TSMC has just gotten better and better, and providing this exceptional partnership proposition to really do what anybody asks them to do, providing they pay, and have scale. So I think that's the first thing. The second thing is this cost efficiency piece, which up and down the income statement and the cash flow statement, it just gives you huge flexibility to pivot, adapt, modify, as we saw Nvidia do with its Blackwell processor that's coming up. It had a mask issue. It changed that almost immediately, and as it was doing that, TSMC were taping out the adjustments to the manufacturing process. So that partnership gives you the ability to be incredibly flexible, incredibly capital efficient, and really more than anything else is to focus at scale, right, on your core competency. So focusing at scale at your core competency means that your management structure is all looking in the same direction. They're all engineers, or mostly engineers, and you don't have this sort of to and fro between who gets paid or who gets sort of leadership in the org structure. And at the end of the day, it ultimately gives you higher margins, and with higher margins, there's more optionality on the business, and that means better comp structure. So all around, it's a very, very clean structure by separating out the sort of very heavy piece of manufacturing and fabrication, but also releasing the business and the org structure from having to manage that.
Cool. Yeah, that makes perfect sense. I think, it's becoming more clear that in these highly technical businesses, there's a lot of nuance that's necessary, and a lot of specialization seems to be key. I guess when you look at this evolution of the semiconductor industry, is there any parallels you could draw to other sectors that you think are similar in nature to the way that this has evolved?
Yeah, I mean, we've talked about this a bunch internally, and I think pattern matches are great ways to help investors understand broadly speaking, how an ecosystem will play out. And we kind of came to the conclusion or felt that biotech, which is reasonably well or better understood, is a good pattern match. And certainly, I feel like it validates the framework, right, that we're laying down for Fabless, in that, all of the innovation, all of the sort of intangible assets, that's the people and the patents, are in one business structure. And then the heavy infrastructure around manufacturing is elsewhere. One, if it works, has much higher margins, and the other, if it works, has lower margins but more predictability. But I think that the sort of important piece here is just sort of separating out the higher risk piece of biotech, or the higher risk piece of Fabless, and the idea really behind SMHX is a portfolio approach isn't really probably the right way to do it. And I think the last sort of piece of validation is just simply looking at this exceptional growth in Nvidia, that when you strike gold, you strike gold. So, in reality, portfolio approach gives you the ability to cast a wider net. And I think it's simplistically, that's the best, as a pattern to sort of match the two out.
Sure. Yeah, that definitely makes sense. I think I don't think anybody's arguing now that maybe it looks opportunistic to still believe in Nvidia, but do it in a diversified way with some other names that can maybe compete away a little bit of the market share that Nvidia has garnered over the last couple of years.
But I think
yeah.
sorry, just an important point there, just Nick, just to add on that. But also, I think layer in optionality. I mean, I think where we are with Nvidia is just these eye-popping beat and raises. Now, it's possible they come back, but as I said, very large numbers make it much more difficult to beat. Sure. And with more of a portfolio approach, you introduce sort of the smaller caps that may have Nvidia-like opportunity sets going forward from the past.
Absolutely. Absolutely. So, as we draw that parallel and we talk about the space as a whole, it makes sense that, manufacturing chips in-house has just become kind of economically and strategically less viable. When you look at the space as a whole, the high cost of building, maintaining state-of-the-art fabrication plants, rapid pace of technological advancement, they've just made it very difficult for those vertically integrated IDMs to keep up in the space with fabless names, right? Not to say that they're going away or anything of that nature, but as technology advances, it's going to be more important and more imperative for faster innovation. So just an interesting kind of tidbits here from a data perspective, right? CapEx to cash flow of fabless names versus IDM, which is integrated device manufacturers, those vertically integrated, right? So you can see the spending on CapEx to cash flow is far lower within the fabless space, but the spend on R&D is much higher, right? So rather than spending that money on manufacturing and the equipment, they're able to turn around and invest in R&D and look for the next technological, evolution of whatever they're working on. So I think that's important, and that's kind of shows itself over time with total return and what it looks like from there. So that's where we see the opportunity of what Nvidia has done and what has kind of proven the business model to be successful. We think Fabless and other names can do that as well. So I guess the next thing that I would want you to illustrate for us, Angus, just with your breadth of knowledge kind of in the space, is just how did we get here, right? I know that you have always iterated to us like it's a very interesting path that we've taken to get here, and there's been a lot of foundation laid from other companies to get to this Fabless and being an opportunity. So I guess talking a little bit about the timeline of how it happened and what's important, I think is useful for people to hear.
Absolutely. I mean, most of it, I think, to me, sort of centers on the sort of origin story of TSMC, and really this exceptional gentleman, Morris Chang. He was MIT and Stanford, worked for TI, for the longest time, became frustrated that he wasn't able to have an impact with his design capabilities. Went back to Taiwan, partnered up with the Taiwanese government, established TSMC to do exactly that, to enable exceptional engineers and designers to have a platform to manufacture. This happened in the sort of mid 80s, sort of at the time Altera were doing what they're doing. Qualcomm enters the picture right around that time, realizing that there are other ways to manufacture. Now there are a bunch of foundries at that stage. TSMC literally became the best, and it became the best because of its exceptional attention to detail and customer service. So that allowed it to sort of pull ahead and invest in much more complex machinery processes. ASML obviously came along for the ride. Lam, and a bunch of names. And I think that ecosystem is broadly represented by our ETF, SMH. One of some more interesting points in 2009 is AMD spun off their manufacturing process. And the reason I mention that is because AMD, the CEO, as TSMC were scaling their business, was the guy who famously said, "Real men have fabs," right? You don't use an outsourced fabrication, but they were smart enough to realize that they needed to pivot. They spun off global foundries. And I think that's the last point also, is like, we know fabless design. We know it because Apple is one of the biggest fabless designers out there, and the biggest customer of TSMC. So there's an ability to unplug from the need to manufacture. Just as you said, Nick, really well, just creates these streamlined, innovative design businesses that have the flexibility to move on a dime and meet customer requirements or meet tech requirements in a very timely way.
Yeah, absolutely. And I think we saw where AMD did it again, right, with their recent acquisition, that they've purchased another manufacturing firm that does design, but they're spinning off the manufacturing because they believe in the fabless. So it's just kind of cements the idea that fabless in this environment is the way to go. So totally.
I mean, an interesting point, and you and I spoke about this yesterday, was this idea that AMD chopped that piece off. They've really sort of reorganized the business in an incredibly successful way. And one of the best metrics to sort of look at that now is, as Intel's struggles with headcount. AMD are doing a better job on pretty much all metrics, with 1/5 of the labor force.
Right. Yeah, absolutely. It's you don't need the head count, right? it's you just need the right head count, not the most head count.
Right. And the innovative power that
Yes.
that sort of streamlined model brings to the table.
Yes, absolutely. Yeah, we appreciate that. So I guess maybe to pivot here and talk, about what we're offering in SMHX and bring that to you guys as, fabless companies like Nvidia, and their competitors, AMD, which we spoke to, ARM, and the like, are really leading the charge and focusing on design, innovation, while outsourcing that manufacturing, right? So the VanEck Fabless Semiconductor ETF, SMHX, is really all about tapping into the most innovative and growth-driven companies within the semiconductor industry. We believe they can fuel faster innovation. They're going to have greater efficiency. They have the potential for stronger financial performance. It really positions them as the future leaders in technology. And as with all of our thematic ETFs, we really want to bring pure play to the table, right? So these companies have to be 50% or more in revenue from semiconductor activities, but then they also have to be defined as fabless. So you're not going to get dilution there with companies that may or may not have large fab manufacturing within their business models, and we're really trying to give that pure play aspect to the space here, and it's one of the first in a sector specific with semiconductors, right? So I think that's super interesting. So what we'll do is kind of turn it over to Q&A and talk a little bit about what you guys have questions on. I'll kind of start it off to get us going here. One of the questions we got a lot of feedback from sales on when we were looking at this was, the CHIPS Act. A lot of money has gone out to TSMC, Intel, all of these manufacturing companies. What does that mean for fabless chip designers? Because they may or may not necessarily be getting the actual funding, but what does that mean? So I guess, Angus, can you maybe talk a little bit about that and just kind of how that plays into it? Because obviously that's a big topic of conversation for the space.
Yeah, I mean, I think I would answer that with a definitive, point of these business models is they are exceptionally innovative. Now, TSMC delivers at scale the most complex solutions at the sort of lowest or highest lithography required to meet specs from the likes of Nvidia and demand. Now, at the other end of the spectrum, innovation is creating solution at much lower cost, right? Grok is a fantastic example here where actually they don't want the super expensive, super complex process. They're moving the complexity into the software layer. So, naturally more supply, right, will favor, right, optionality of design, right? So I think that'd be my first point. I think, the second point is, naturally you want to disperse your geographic and geopolitical risk in the world that we're in now. And that, in addition, will favor the smaller players. So the idea, I think, behind this fund is the small guys have as much chance to succeed, but they need the manufacturing processing capability. Now, more in-house on the ground allows them to build the relationships without having to try and break into TSMC. And they'll optimize their design process to what is available to them. So I think it's the more the better.
Yeah, absolutely. I don't in my mind, having additional capacity only means opportunity for designers out there that want to be on the cutting edge of the next chip, right? And they can utilize that. So I don't think that that's an issue at all. I think it's a definitely a saleable point versus a detriment. So
Yeah,
and we got a couple questions. So we'll go with this one. Is a lot has been made of the investment by some of these enterprises with Nvidia, right? And are they getting the return on investment? I think when we were speaking, you drew a parallel to kind of Internet 1.0 versus 2.0 and laying that foundation. Not to say to get into the weeds with it, but maybe just high level, if you can give us an idea of maybe the parallels there and what that looks like, and if we think it's worth it that these companies are spending that money.
Yeah, no, I mean, I think this point has been raised quite visibly. Sequoia wrote a pretty large white paper on it. I think Goldman have also sort of jumped in, but I think that the VC community is getting pretty squeamish about actual modality and profitability of the infrastructure that's been put in place, and that's somewhat understandable. I think, again, to put it into a sort of framework that people can sort of think about, Internet 1.0 sort of turned up in the mid-90s. We had that sort of infrastructure boom, not dissimilar to what we're having right now. And then 2000 happened, and as we know, the Nasdaq and most things internet looking, share prices came down pretty hard, including the likes of Amazon. And really, if you wanted to try and put your finger on what changed and when things started to take off again, it was probably modality. It was probably iPhone, the apps that really allowed sort of mass adoption at scale of monetizable business models. So I think it feels to me, and again, the pace of this or the cadence of this is probably going to be much faster this time around. There is going to be a period of latency between putting down the expensive infrastructure and being able to monetize it.
Gotcha. Oh, that makes sense. I think that's well explained. All right. Well, I think that's where we're at. We've run up on time, so we appreciate everybody for joining today. If you have any additional questions, please feel free to reach out to us, or I think we'll have a replay of this as well that you'll be able to access. So again, thank you for joining us, and we appreciate the time.
Thank you, everyone.